Always appreciate coming here and talking to you guys. It's a very informed crowd. For the last 5 or 6 years, the budgets have been extremely boring, so we've focused on other things around the budget. This is the first, Tim used the word meaty budget for a while, and you know, the spoiler alert, it is not kind to independent retirees. It's not punishing either, but there's nothing for you and they're going to take away a few little things. But I can talk to you about how to get around some of those things as well. Just check the tech. So here we go. So when I first started to absorb this budget, I was trying to think of a summary. What does this mean? And some of the words that came into mind were messy. There's a lot going on in terms of structures, particularly, and I thought I'd get a show who still has any sort of family trust that they hold assets through, and I thought there'd be a few. Anyone holding assets through companies, or bucket companies, beneficiary companies, and plenty of super here, I won't ask that. So we're going to talk about trusts and what that impact has as well. But messy was one. What's the stated purpose from Chalmers and Albo about what they're trying to achieve here? What have they said they're trying to help? Who are they trying to help? Younger generation. Yeah, I think this has zero help for them, by the way. And I think it's going to tax their parents and their grandparents, which doesn't help the bank of mum and dad, which is actually helping some people into housing. And I'll talk about why on all this stuff as I go through the measures. But you know, the most obvious thing they're getting straight up for the younger generation is a $250 tax rebate. Now that doesn't go far. It's certainly not buying them a house. The only help they may get is some of these policies, depending on who you talk to, are predicted to maybe drop the housing market in the next year by 2 to 5%. Now, it's very hard to predict that sort of stuff, and there may be other factors like interest rates that make that worse or better as well. This is an attack on aspiration. So this is Albo going back to the shortened policies of 2016, where they did not get up in the election, because the Labor Party has always had this issue that capital gets taxed lower than income. So someone that earns $200,000 in income pays a top marginal tax rate of 45%. Someone that makes a $200,000 capital gain gets a 50% discount, and the tax is then taxed based on their... So it's maximum tax rate of about 24%. Now, that's going to go up to 30%. I'll go through the mechanics of that shortly. But for most people, it's going to be still in that range of about 20 to 25. So it's not sheep stations, but what it really taxes is aspiration. So for someone starting a business, and picture, we now move into this world of indexing, and I'll go through all of this, but someone's starting a business and they put in $10 in their own sweat, and they build years of not taking salaries, etc., and they build that business to be $1 million over a short period of time. What's $10 indexed for 2 or 3 years? Not much. I'm not even going to do the calculation. Maybe it's $12. So they're now paying tax on the whole lot. They may pick up the small business exemptions if they've got turnover under $2 million or assessed assets of $6 million or less. But it's a tax on that aspiration. It's not terrible. So when I look at this budget, it's neither complete knockout bad, nor is it... There's a few good things in there, but nothing crazy. It's an absolute goldmine for accountants as people restructure. Every person in Australia, there's 1 million family trusts in Australia. All are going to have to be reviewed and potentially restructured. That's a lot of work for accountants and lawyers and financial advisors as well. Who has testamentary trusts built into their wills? And I imagine that's a lot of you. Testamentary trusts are an innocent bystander of these changes at the moment, whether they'll get exempted. They've specifically excluded fixed testamentary trusts, but no one really has fixed testamentary trusts. They're broad. It allows you to distribute. The typical case is you leave it to your kids and they have the ability to also distribute to their kids and their grandkids. That makes it discretionary. That means minimum tax of 30%. Therefore, all the distributions to the young kids at adult rates goes out the window. The simplest example of this, if I've got a testamentary trust of $1 million and I'm distributing $60,000 a year and I've got 3 kids or grandkids, I can distribute $20,000 to each of those and they'll pay no tax because they're subject to normal adult tax rates. That 60,000 now is subject to the 30% minimum tax, so 18,000. It's a death duty, effectively. Now, you can get caught up in all the words and things here, but let me launch into some of this, and I'll give you more examples as we go through. So existing assets are protected and grandfathered, but I added there mostly because if you've got an existing share portfolio, existing property, existing business, as budget night, going forward, so the past is protected and grandfathered, so you'll get the 50% discount, but going forward, you're now subject to the indexing rather than the 50% method. Now, that might be good, it might be bad. If you have capital growth that is relatively low, it's probably better. If you have capital growth that's high, it's probably worse. Picture commercial property. Is Bernie in the room? Anyone with commercial property at all? So picture commercial property pays you a yield, and in general it grows with inflation. It can grow by another factor, which I'll touch on in a minute, which is what happens to interest rates, but it doesn't have big capital growth, it has high income. Whereas picture a growth stock that has very low dividends, and you're buying it because it's going to grow, you're going to pay more tax on the growth there. So some assets will be technically more affected by this change to capital gains than others. You would never change the way you invest just based on tax. You might a little bit, but you wouldn't change just on that. Super is absolutely the winner. It's the first budget for a while where there's zero changes to super. Cross the fingers that that's the path. It's very hard. You saw when this budget was announced, everyone was saying, well, hang on. Before the last election, Albo, you stood there and said, I'm not changing capital. There's no chance we're going to change capital gains tax or negative gearing. 1 year and they did that. But yeah, in fairness, Howard did that with GST. Politicians do that all the time. That's what they do. So superannuation, they've said no changes. I'll talk about Div 296, which is the $3 million tax shortly. While that's not specific in this budget, it comes into operation from 1st of July this year. And it's now legislated, so we know exactly what it is. Any new investment, whether it's you guys or your kids in business, etc., are now subject to the new rules. So that means they've got to think about the structure that they own assets, whether they're buying a business or starting a business in a company or a trust. Trusts are the big loser here. So the government and the the Labor government and the ATO hates family trusts because it gives all this discretion. There's not a lot of record keeping. If you own a company, you're lodging an annual return with ASIC each year that tells ASIC who the directors are, who the shareholders are, where they live, and everything else. Who's got a family trust? You've got a deed. In that deed it says, I can distribute to my spouse, I can distribute to my kids or my grandkids. It's broad. It doesn't name them. So they don't know that. They have less control, less visibility. So they don't like it. They don't like the fact. And look, some of it is fair. If we picture, there was an article in the AFR on lawyers and accountants and others who structure in partnerships. And traditionally they run a service company and they'll split some income with their spouses if their spouses aren't working. So call it 50,000. So it's fairly nominal, but that means they've shifted 50,000 that would otherwise be taxed at top rates through a trust structure to their spouse, which now gets taxed at maybe 5,000, so it's about 10% average rate. So the poor, no one's going to feel sorry for the high-charging partners of these firms, but they've just now got to pay 30% minimum on that trust distribution, 15,000, so an extra 10 grand. It's not going to make or change anything. And there'll be some people who might say, that's fair. I'm a doctor, I get paid a salary, I don't have the ability to split my income. Why should someone that's self-employed? And that's the logic behind that. Now, you can sit and argue about all this stuff, but it doesn't make any difference. Some of it's fair, some of it's not. So, and I'll dive deeper into these as I go through. So trusts losing their edge. So 30% minimum tax. That tax is provided by the way of a non-refundable offset. Now, picture if you're paying tax in a company. When you pay tax in a company, whether it's you or BHP, what do you get for it? Favourite thing for retirees that cost Bill Shorten the Prime Ministership, you get franking credits. And they're still refundable if your marginal tax rate is below the 30%. So what they're doing with the trust now is it's a non-refundable offset. So if I distribute to kid who's at university and they, in the past, would have paid zero tax on that. The trustee now has to pay 30% tax on that. So let's say it was 30,000, so there's now 30% tax, 9,000. Now, that beneficiary will get a credit, but if they have no other income, they don't get a refund of that tax like they do with a company. So clearly companies are going to get picked up in this, and I'll talk more about strategy around that. The story that's not anywhere here is about inflation and what that means for interest rates. Has anyone ever looked at, I'm sure in your IDG group, you talk about how to value companies and how to value businesses. And I don't want to bore you with the formulas and stuff, but it's pretty simple in theory. On the top line, you're predicting all the future cash flows of an investment, whether it's a property with rent or whether it's profits from a company. And then you discount that by the risk-free rate, which is called the 10-year bond rate. And everyone's looking forward for this stuff. So if you're trying to value NVIDIA effectively, the hard bit is we can tell what they might earn next year, maybe even the year after. But what are they going to earn in 5 years or 10 years? Very unknown. If you buy a commercial property, you can kind of value that. And you don't necessarily do this technically. But let's talk about property, because this is the heart of this budget and whether it's going to be affordable for kids. And to do that, let's go back and look at why property ran so hard from the 90s through to where we are today. So let's go back to the early 80s. And you guys will all remember it, as do I. I was just starting off. I think I was with Wardley Australia, and an investment manager at this time. Now, what were mortgage rates back in the early to mid-80s?
18%.
They got as high as 18, 23 if you're a Kiwi. Now, I've just said the denominator of valuing anything, you divide by the interest rate. So back then, if you were getting $100 of income and you were discounting it by the interest rate, let's call it 20%, you'd be only willing to pay 5 times the earnings for that. Now, let's jump to the other side of affordability. What does everyone do when they buy a property? Do they fund it with cash, or where do they get the money from? Not counting bank of mum and dad. From the bank. Does anyone know how much the bank will lend you based on your income? What percentage of your income will they allow you to go to in mortgage repayments?
No.
And it's never changed, by the way. This is my point. So it's about a third. Sometimes a bit lower, 30%, sometimes a bit higher, 35%. So for the last 30, 40 years, people looking to buy a house go to the bank. How much can we borrow? You earn 100,000. We'll let you repay 30,000. You work out that's a loan of X, and you go out and buy a house for that. So when interest rates went from 20%, 17%, slowly down to 5%, what does that do to the value of everything? It pushes it up. So the value of every asset, whether it's shares or property, it automatically pushes it up for 2 reasons. 1, just the discounting of the future cash flows at a much lower rate. And 2, the fact that borrowing costs are lower, the bank will lend you more, so the market goes out there and pushes it up. So the number 1 reason property has gone up in Australia the last 40 years is interest rates and inflation, by a mile. None of this is talked about when in terms of solving. Now, on top of that, the other reason is supply and demand. So that is how many people are trying to buy something, how many people are trying to sell something. On property, you've got supply issues, which is just how many properties can be built and how easy that is. Nothing in the budget. There's a few tiny things that attempt to address that. We'll see if it does. But then there's the demand side. So what affects demand? Quite simply, how many people are trying to buy houses. So that's as simple as what's our population, what's our natural increase, what's our immigration, etc. And in that period of time, our population's doubled. Now, that's good because we've had extraordinary economic growth off the back of that. So that's meant Australia. And the US and Australia are kind of unique in that their share markets for over 100 years have averaged 10% and slightly more. What do they both have in common? Steady immigration throughout all that period. If you find a country that is flatlining in its population, picture Japan right now, you'll have way less growth. So it's the dirty little secret that we need, and right now we're in a very low growth I'll go through the growth numbers forecast, but they're 1s, 2s and 3%. It's pretty ordinary. Now, we're in a per capita recession. We have been for 3 to 4 years. That means if we divide GDP by the number of people in the country, we're just not growing. We're going up slightly purely because of immigration. Now, there's a lot of colourful debate around immigration, and I'm not going to get into that at all. I'm just going to talk about that. So the good side of immigration is it brings growth. The bad side on property affordability is there's not enough houses, so that also pushes. So picture inflation in one corner and interest rates as the big driver, and supply and demand, distortions in the short term that are driving property. So that's what's driven that. None of anything in the budget overcomes that. So let's start to look into some of the measures. There's kind of 4, they all come in different timelines as well. So we've added Div 296 in there. That won't fit everyone, but it sets the scene about comparative tax rates in different tax structures. So think about tax structures as you, as an individual, joint as in a couple, companies, super, family trust. They're the ownership structures, and different tax rules apply to each of those things. So superannuation, we now know that pension cap, call it $2 million, indexed, tax-free. Clearly the best tax haven on the planet. You don't have to go to Bermuda, you don't have to go to dodgy countries. We've got the perfect tax-free status in a civilised country with rule of law. So $2 million each per person, tax-free. Now, if you start with $2 million and you get better returns than other people, it stays tax-free. So you're not getting punished as it goes up. We get to $3 million, and this is where Div 296 tax comes in. So what was the extra percentage they've added for people over 3 million but below 10 mil? 15, yeah. 15, now, sorry, I've skipped the bit in between. So between 2 million to 3 million, if you leave money in super, you're getting taxed at 15%, which is still better than companies at 30, and still better than marginal tax rates, which are generally going to be higher. As soon as you go to 3 million, you add the extra 15. So for 3 million to 10 million, the tax on that is now 30%. Same as a company, same as now the trust tax rate. So it kind of levels the playing field. So when people are saying, maybe I should pull whatever's out over 10 million. This is not many people, by the way. The over 10 million is only, I think it's 70,000 people in Australia. So it's not nothing. And I don't think anyone envisaged that someone with 100 million in super should be tax-free, except maybe those people. But I don't think anyone else would picture that. So what are people going to do? They say, when it was not indexed, people were rushing to think, do we pull money out of super, put it into trust, put it into companies, etc. Now we know that between 3 and 10, if it's 30, there's no clear benefit of putting it in a company or a trust, except a few nuances, which I'll talk about in a minute. So above 10, they now add another 10%, so it's 40% above $10 million. I'm not going to ask in the room, I don't want to, but that's, once again, it's a small number of people. We have clients in that bit, but it's a very small number compared to what I call the mass affluent, which are in that 500 to 5 million sort of space, with the median for the mass affluent of, call it $2 million. So that is in effect from 1st of July 26. Not a budget measure, but confirmed and now legislated. And it's interesting because super has not been touched. So we've now got a clear comparison, super versus other structures. So then we've got from 1st of July 27. So that is the start of next financial year. We're just clearly coming up to 1st of July 26. So we hit 1st of July 27. Indexation and the 30% minimum capital gains tax rate comes in. So as it says there, individuals and trusts, super excluded. So super in pension mode, picture up to that 2 million, no capital gains tax. Super 2 million to 3 million, not in pension mode, 10% capital gains tax, far better than the 30% coming in, so it's still good. And above that, it catches up. So individuals and trusts is where they're targeting here. So they're absolutely trying to do that. So a company does not pay capital gains, they just pay standard company tax rate. So a company of more than 50 million turnover or whatever, that's 30%. Smaller companies are 25%. Investment companies that don't operate a business are 30% as well. So all of a sudden we're starting to see some level bits. And this is the bit that to me kind of makes sense. So when people are starting a new venture now, they're not going to dramatically distort the way they do it based on these rates. Fast forward another year, 1st of July, also 1st of July 27, negative gearing is restricted to new builds only. So if anyone's negatively geared now, that's grandfathered and they can keep being negatively geared. And what's negative gearing? It's just where the money you pay out on an investment property is more than the money you get in from the rent. Why do we do that in the past? Because we get a tax break off so for a high-earning doctor, it's earning $300,000 a year, they want to save tax. It's been one of the only ways they could save tax. We can only put $30,000 into super, so they go and negatively gear a property, they get a tax break. Is that good or bad? It just is. Yeah. So we can argue about whether that's good or bad, but it just is at the moment. So that will only apply to new builds. Now, what will that do? Do we get a two-tier market where investors are chasing new builds and young first home buyers or others are chasing non-new builds? But as an investor, I go, well, if the secondary market, so existing houses that aren't new, drops a lot, I'm going to buy it just because it's now a better investment. So I don't think I'm getting out of that race. I can neutrally gear. And what you find, who's ever had, I imagine plenty of them have had a negatively geared property at some stage in the last 40 years. So yeah, there's lots. What happens over time as the rents go up? It's not negatively geared anymore. So even though it's grandfathered, most properties within 5 to 7 years that are negatively geared now won't be negatively geared. So there'll be no negative gearing off the back of that. They haven't done this, so Ollie just checking and confirming. It's just residential property here, isn't it? Yeah. So you can negatively gear a commercial property, much harder because the rents tend to be higher than interest rates. You can negatively gear shares, much more dangerous because the share market is volatile, but at the right time can be highly useful. So for young people trying to build wealth, they've taken away the easiest and safest way with that. The day after the budget, we had a 35-year-old couple in. We were talking about strategies. We went, that one's out. And they need, at that stage, they weren't massively high earning, but they needed a cash flow neutral property after tax. Now, over the last 10 years, they've got rid of depreciation, which is the write-off, the tax write-off you get on a property, except for new properties as well. So now an older property is less advantage from a taxation point of view, but for lots of people they'll choose to neutrally gear, or they may be neutrally geared already, so no impact necessarily. And for sharp investors, if they see a drop in the market because of this, they're still going to come in just because it's cheap. And particularly, you can actually renovate and pick up some depreciation or some negative gearing, but that's another story. 1st of July 2028, then we get this 30% minimum trust tax. So that's the one I was talking about. So we've got, that's a couple of years away, and they've allowed for restructuring to happen before then. What's restructuring? They'll allow you to move your trust, wind up your trust, move the assets. Now, let me just add the biggest warning out of this. None of this is legislation yet. It's all announcements from the budget. It's complicated just thinking about it. Then we've got to read the rules when they come out and work out, are there any unintended consequences? What do the rules actually say? What does it actually look like? They're talking about rushing this through. I can already see fatigue setting in from Albo and Chalmers. It's good to watch as they try and defend this because it's indefensible. A third of young people think this is a dodgy budget, and because they know deep down it's not helping them. The other 2/3 probably don't understand it. So, yeah, and I challenge anyone to show me exactly how this helps for them, except unless this causes the property market to crash. Now, Chalmers and Albo aren't going to stand up on stage and say, we want the property market to crash 20%, because everyone else that owns a property is going to not like that. Although there's some interesting theory that says if all of a sudden all property prices halved, for people that are already in the market, does it matter? It does if you've got debt, by the way, but for people that don't have debt, your next house is halved as well, so it doesn't kind of matter except for your legacy and everything else. But no one wants that to happen. So, and it's too much theory, and this is stuff academics come up with. Common thread, in theory, nothing's retrospective, but a lot of these things will slowly take over. Capital gains, all of a sudden, pre-1985 assets. Has anyone got any pre-1985 assets in the room? I'm sure there's some, yeah. So they're now subject to tax from this point, but on the index bit, not the tax from. Let me do an example. Let's say someone bought a parcel of shares for $100 in 1984, and right now those shares, depending on whether it's CBA or CSL, but mind you, that's just been smashed. But let's say it's worth $20,000 now, because compounding over that time does a lot of things. So the cost base for this will now be the $20,000. So going forward, that will be indexed, and when those shares are eventually sold by you guys or your estate, there'll be some tax. Now, I don't know if I call that grandfathered. So, because you've now got assets that weren't taxed that are coming in. I don't know, and I'd call that a death tax as well, because it's going to be realised on death. So, yes, it's not retrospective, but I put in the but there because I think assets that didn't used to be in the mix are now in the mix. Everything's delayed, so there's time to work it out. And I would say the number one theme out of this is if you have stuff that's subject to capital gains tax, if you have trusts, if you have companies, you should be sitting down with your advisors and working out what's sensible to do. But you don't need to do it now because we don't have the rules yet. Div 296, that dragged on for 2.5 years before it was legislated, and they bowed. We talk about, and I promised someone I wasn't going to say Trump today, but we know that Trump always chickens out, the taco thing. Albo kind of always chickens out as well. So Div 296 that Chalmers wanted to put through, he succumbed to the indexation on that, and he succumbed to the not on unrealised gains. And as soon as they did that, most resident people go, yeah, I can actually get it. So, but the unrealised, tax on the unrealised gains and the no indexation was the poison bit there. Let me jump into some of the details on some of these, and I'll use some examples. So there's two changes to CGT. One is the way you calculate the gains, and the other is how it's taxed. So the way it works now is if I buy something a few years ago, $100, and I sell it for $200, I've got a $100 gain. We'd call that a gross gain. If I've held it for more than 12 months, I get the 50% discount. So I pay tax on $50, but that's my marginal tax rate. So if let's say that was $50,000, and let's say it was a husband and wife. We split that $25,000 each. How much tax are you paying on $25,000 each if you've got everything else in super? Nothing. But then step two, they bring in a minimum tax rate on capital gains of 30%. So that same $50,000 would now be taxed at 30%, $15,000 from when it comes in. And it's a little bit mean because it doesn't actually affect Gina or any of the billionaires because they're already on the 40% tax rate. It affects retirees with $1 million outside of super. So picture that sweet spot, and I'm just talking about capital gains here, but some of the other taxes affect this too. But if you've got, like I said, a couple that's got most of their money in super, but they might have a property or an $800,000 or $1 million share portfolio outside of that, that isn't troubling the taxman right now. If they own that in a trust, and actually hold that thought, there's multiple, you can see here there's multiple attacks in different ways. So how many people delayed selling an investment property that they had till after they retired? Because tax rates were going to be lower. Yeah, there's tons in the room. We've had a couple of meetings this week with people where that's been our plan. Sell your investment property after you retire because the rates are going to be lower. Now, they still get the 50% discount up to, what's the date, Ollie? 1st of July 27. So if they sell it any time now, the 50% discount rule still applies. If they sell it after that, it still applies up to that point. But they're going to have to go and get a valuation. Now, shares are easy. What's the market say? There's a valuation. Property. Do I get it from my mate, the real estate agent down the road? Do I tell him to make it as high as possible? Do I kick the licence value from Heron Todd White, a couple of cartons of beer, and say, can you push that up $500,000 or so? How will they know? But it's going to create this whole industry in rubbery valuations. Yeah, and will they be able to check them all? Probably not. We all know that our rates valuation has no connection to a market valuation. So they can look at the differences there, but it has no actual connection. So one is how it's calculated. So we move back to indexation. I even see Paul Keating in the press this morning saying it's back to the way I did it. But he's quite an egotist, so he's kind of happy it's back to his way. Now, indexation we're back to interest rates and inflation. So we index according to inflation. In a low inflation period, the base won't go up by as much. In high inflation, it will go up. Now, what tends to happen in the 70s and 80s, when we had high inflation all around the world, and in Australia, to use for this example, we had inflation that averaged double digits for nearly 20 years. The growth on property and shares was spectacular, partly because what happens to rents and prices when inflation goes up, they go up with inflation. So that perpetuates. But that means if you own a property, there's turmoil initially when rates start to go up because some people can't afford to pay the loans, they sell. But for the people that hold through those inflationary times, it's the best time in the world. Shares averaged through the 70s and 80s, nearly 18%. But with inflation averaging 12 to 13, it was just inflation plus 6. In this last decade, we've had inflation average about 2%. What have Aussie shares averaged? 8%. So there's a direct connection. So for investors, you'll pick up in high inflation, assuming the debt obligation doesn't force you to sell. And that's why you get so much volatility. You can picture a chart of the early 70s, crazy volatility as interest rates went from 5 and 6% through to the high teens, where some people had to sell assets. But once people got through that, then we saw this steady rise. And if you can find a share chart that goes, you can look at from when the 74 crash happened all the way through to the 87 crash, it was a 19% average from the bottom of the market to the bottom of the market there. High inflation, high interest rates. So then step 2 is the 30% flat rate. Now, in the past, picture that couple we're talking about who sell a property or shares post-retirement. Now, there's also things like superannuation deductions. So, because currently you get taxed based on your gain, discounted 50%, added to your marginal income, but you can reduce your income for marginal tax purposes by things like super and other deductions. So what we'd often do with people is we say, you're going to retire, sell the property, we're going to put money into super, and there's little tricks. You can do 2 years at once if you've got a self-managed super fund. If you're in that situation, ask me afterwards. But if you happen to push your balance below 500,000, you can do catch-up contributions. It's about 125,000 for people that haven't put in any money for the last 5 years. Noel Whittaker spoke about that a few years ago at the session we did, wherever that was. So a couple could easily get 250,000 of deductions if they planned ahead. Now, they've got to have under 500,000 in super, but they might do that deliberately to get a big enough gain. All of that's gone now because we're going to have a flat tax on the gain. So it doesn't matter whether your marginal income is 0 or $1 billion, you'll pay 30%. Sorry, 30% is the minimum. You'll pay higher if you've got a tax rate that's higher. So once again, it doesn't pick up Gina, Cannon Brooks and all the billionaires. It picks up the people that have got a little bit over in super, and it's mean. It robs them of 20 or 30,000 in the same way the trust stuff does, because they can't plan around it. And I go, it doesn't help. By the way, this now applies to the younger generation, who are now going to pay more tax on their thing. That's not going to make them more likely to invest, and they'll still invest. So excluded from both of these is super, SMSFs, companies. Companies are already taxed at 25 or 30%. And keep in mind, companies get a franking credit. So all of a sudden, companies as an investment vehicle start to look a lot more attractive than trusts. Because yes, you'll pay tax at 30%, but you'll get a franking credit rather than paying the trust tax rate at 30% and getting a non-refundable offset. Fixed trusts, charitable trusts, deceased estates are exempt, but the devil's in the detail around these testamentary trusts, and we talked about before, lots of wills have testamentary trusts built in. They're nearly all discretionary. In other words, because they allow me to stream between my kids, my grandkids, or whatever. So that will mean they will be taxed at source 30%. Now, I don't know the alternative yet about how you do that. You can have fixed trusts, but that defeats the purpose. Do I need a trust for every grandchild? You imagine the complexity of the wills around that. None of it's legislation. You're going to see public outcries. And like I said, if elbow always chickens out, we may see some changes on that sort of stuff as well. So super, all of a sudden, as I was saying, is now by far the #1 strategy. And particularly for what I'd call the mass affluent, people that have got less than 2 million in each of their super accounts. It's just easy. It's all tax-free. Nothing else matters. You'd be trying to get as much as you could in. The challenge is for anyone over 75, there's only one way to get money into super. You know what that is?
Keep working.
No. Well, yes, you get a little bit of the contributions, but it's the downsizer. The downsizer doesn't have it. And for some people, it's pretty practical. You wouldn't downsize your house just to get money into super, but it's a nice byproduct for some. But yeah, personal income, 30%. Obviously, the 30% tax rate goes from 45 to 120. So for anyone above 120, we jump up to the high 30s and the 40% tax rates. Discretionary trusts now have this 30% non-refundable offset. Superannuation in accumulation phase, 10% capital gains. Superannuation pension phase 0. So super, a clear advantage. And for us planning for people's retirement, getting the end game in super becomes the number one thing. So for your kids that are still working, getting their structures and strategy right so that back end is in super. And you can't do what a lot of us did, or a lot of you did, which is build it outside of super, then pile it in at the end. When we spoke about the budget in 2007, Peter Costello brought in limits on super and said, all right, last hurrah, everyone can put in $1 million. We're never going to change super rules again. We laughed, and he didn't change many after that. But yeah, so lots of people at that stage could sell their property. Now, it was a terrible timing, as these things often are. This budget is terrible timing as well, which I'll talk about in a minute. So what happened then? People sold properties, put $1 million into super, and if they were dealing with product salespeople from banks and insurance companies that went straight in the fund, what happened to the market in 2008? Down 50%. It's terrible timing. Yeah. Now, for those that did it smarter, they were okay, self-managed or with good advice. Where are we now? What's the property market done for the last 10 years in places like the sunny coast? Hot, hot, hot. They're bringing this changes. What's also happening to interest rates right now? Going up. So we've now got this interest rate. So we're going to see property under pressure. Not complete pressure, because I think something like 2/3 of property purchases these days are done with no finance. So that's people that already own their house, that are upsizing or downsizing, and they've actually got the cash. But at the margin, just like those people in the early 70s that had to sell their properties when interest rates went through the roof. Now, it's almost inconceivable that we could have that outcome again. But when the war started, US-Iran, what was the S word that came back into people talking about? There's a combination of inflation, stagflation, yeah. So in the 70s and 80s, we had stagflation, which is where we had inflation and no growth. Most times when you get inflation, it comes from the economies growing too fast. They can put interest rates up, they slow it down, and it brings it down. If you've got stagnant growth and inflation, what happens if you put interest rates up? You make the recession even worse. So that's a hard one. Now, it does not look like we'll get anything resembling 70s or 80s stagflation, but we've got a bit of it already. We've got 1% growth. I'll come to the Treasury numbers in a minute. And we've got inflation, which I'll talk to in a minute, but inflation forecast about 4.5% this year, maybe going to 6 or 7, and then coming down. You'll recall post-COVID, we got some inflation, and there was this ongoing argument about whether it was permanent or transitory. You're going to see exactly the same news stories roll out about this from the energy crisis, whatever you want to call it. It looks almost certain to be transitory, but if I look at Brent crude, as I do every morning, to see what's happening with that war, it's still at 110, or did you look this morning, Matthew? It went from 60 or 70 to 119, then it dropped when we thought it was all going to be over quick, and it's back up at 110. So there's no ships going through Hormuz, so the oil price is staying high. They will solve it, but none of us know when. So whether that's 3 weeks, 3 months, 3 years, we don't know when. The longer that stays up, the more stagflation talk will come about. As soon as they solve it, by the way, oil prices drop, energy prices drop, deflationary pressures. What happens when interest rates drop to the value of everything? Up. So trying to time this stuff is always impossible. So discretionary trusts, as we talked about, we've had a few meetings this week where we've got clients that have got discretionary trusts, and we're quite excited about the ability to restructure those with no capital gains tax. So an unintended consequence here is lots of people that have got tax issues buried in their testamentary trust, in their discretionary trust. I'll give you an example. We've got someone that owns a residential property in a trust. It's their principal place of residence. They bought it in there for asset protection when they were going through some volatile times. The property's gone from $1 million to, I don't know, call it $5 million during that time. And if they hold it forever, it'll probably, it's waterfront, it'll probably keep going to 10, 20 million over the next 30 years. 30% minimum tax on that for capital gains, that's going to be a lot of money with no 50% discount. Ability to restructure, which will be written into the law, we can move that from their trust, wind it up, put it in their own name, so at least all future growth will be tax-free. There's no allowance for these little things in the budget at the lost revenue they're going to get. We had another client 2 days ago that have got substantial Division 7A loans. Does anyone remember those from when they had businesses or anything? It's where people ripped money out of a company that they're trading, didn't pay tax on it, creates this loan, and then to pay that loan off, they've got to do these forced dividends, and it costs them extra tax for the next 7 years. It's a very common thing. This particular client has got about $2 million in loans that their trust owes their company, and that's causing them to have to declare dividends each year on paper that costs them about $100,000 in tax for their sins of the past. And it's very standard in people that run business. I won't try and explain the details. Accountants have trouble explaining this to their clients. We said, hang on, if we can restructure trust now, based on this, we just move the assets of that trust to the company. So that includes the loan that the trust has to the company, and they have no Div 7A loan anymore. Now, around the country, smart tax lawyers, accountants and planners will be looking at ways to restructure trusts that are actually to the advantage of their clients, not to the disadvantage. And I don't think they've allowed for any of that. And I think there'll be opportunities for people, if you've got kids in business, etc. Once again, you want to make sure they've got really good accountants and people to review their structures, because getting this right or wrong is literally lots of money. Retirees, it doesn't affect. Most retirees have got predominantly super and then some money outside of super. Now, the minimum capital gains tax affects those outside of super. So picture, and we'll do 3 different types of structures here. And we'll do a $1 million portfolio owned by a couple. Now, they could own that in a trust. They've now got a 30% minimum tax. Let's call it $50,000 income, 15. If they own it as individuals, $25,000 each, 0. If they own it as a company, they'll get taxed at 30%, but they'll get a franking credit. Now, the simplest thing will be put it out to individuals. You've just got to make sure it doesn't affect your estate planning or any other dynamics, but that will lead to a lot of retirees that have trusts to wind them up one way or the other. Is that good or bad? It just is. And for some people that might be easier. Now, that all works while we have refund of franking credits. But if that now comes back on the agenda, because this is there, and we've got a political challenge in Australia in that the extremes are getting more popularity because people are frustrated with lack of stuff. So on the left, the Greens have more power than they've ever had. On the right, One Nation has all of a sudden got power. So we are heading towards a European type world where you have these weird coalition governments. So picture a coalition of One Nation, the Teals, the Liberals and the Nats. Yeah. But that's the only way right now that the Conservative side of politics is going to get back in. So if that means Labor, and if they're happy to be in coalition with the Greens, just so they can stay in power, all of a sudden, then we start to worry about those things. Now, we can't do anything about it, so I don't want to start worry about that. And I think we're going to see a lot of lobbying and fighting. I think it was Fraser who led the charge for the Libs against franking credits. He's sitting in the box seat. We're going to find out how good he is. And he'll either set the future for the Libs and make them a potential candidate to win the next election, or we've got a long period of potentially left-leaning governments. Help us. I'm conscious of where I'm yeah, so we won't, yeah. So trusts, and I'm going to wrap up there. Div 296, I'm not going to go, we've talked about that. Here's some of the other measures, and it's just nasty, little piddly stuff against independent retirees. scrapping the reduction of the health rebate for over 65s. And guess why? You don't have the control of the vote anymore, so your kids and your grandkids. Make sure your kids and your grandkids know that the bank of grandpa and grandma is being diminished, which is going to reduce their ability to pay off mortgages and buy houses. That's how they got Div 296 back to reality. Robert Gottliebson ran a brilliant campaign with other journalists on saying, this is attacking your grandparents, that's going to affect your ability to pay off houses and stuff like that. So watch the lobbying, watch the stuff going here. Age pension index, that's a non-event. Aged care, there's a $3 billion boost. It's been a year since I walked in here, and I've just noticed the activity around here is crazy. You're seeing that in action, we're seeing it in an ageing population. So I'm assuming that's good, but I will talk about the downside of that. Here's the big one. For all this pain and all this thing, everyone gets $250 from 2027. Yeah. So it's just ludicrous. I like the fact that the opposition's come out and said they're going to index tax rates. There's a lot more work they need to do to make that balance, by the way. So, and hopefully we get some real reform come along, because this budget is not reform. The backdrop on the economy, as I start to move towards the end here, real GDP growth of 1.7%. That's pretty pitiful for a country like Australia, but it's the new norm. CPI, now these are Treasury's forecasts. They're not mine, they're not anyone else's. This is what Treasury is thinking. They have a notorious track record of being wrong in the short term. And in the long term, they predict the same stuff that is the averages. So CPI peaking in June 26, which is soon. Now, what happens if Hormuz stays closed for another year? It'll keep going. So that's assuming it's going to stop pretty quickly. So 5%. Unemployment's pretty good. There's almost never been a better time in Australia for unemployment so low. So it's a good thing. The deficit, this is the annual deficit. So picture what you earn, what you spend. If you spend more than you earn, that's the annual deficit. So it's 1% of GDP. So that means they're going backwards by 1% of the... Now, we mix up numbers here. GDP is the value of the annual income. So it's like someone earning 100,000 and spending 101 for the 1% difference. Not nasty in the short term, but if it balloons, and we'll talk about Australia versus other countries, so this is the percentage of GDP of debt. So forecast to increase to about 36% and then drop to 27%. But anything outside of 2 or 3 years is just rubbery numbers. There's so many things that are going to affect that it's hard to tell. But yeah, it's a long way towards paying that off. And the gross debt keeps getting higher and higher as well. So the peak, 35%. If you look at other countries, this is the general government debt as a percentage of GDP. Japan basket case, US basket case at 123. 6% of that US 123 is paying interest. So they're now paying interest on their interest, and there's all sorts of incentives for Trump's team and his new head of Federal Treasury to keep bond rates low so they don't have to pay too much in interest rate debts. And I won't go there. It's a very complex set of figures. Australia's actually at the bottom end of that. So we're less bad. I'm not going to say we're good, but we're less bad. We don't know as much as the other countries. That's why you've seen our Aussie dollar go up compared to the US. So we've seen, which is kind of weird at the moment, because you're watching, if you look at NASDAQ, you'll see it's at crazy all-time highs. But if you look at an ETF like NDQ, which is in Aussie dollars, it's just back to the high. The difference is currency, because we're going from 69 to 72 cents. Sorry, in terms of, let me go back, sorry. I just went the wrong way really quick. I've always put in, because I think it's informative, where the money comes from and where it goes to in the budget. The budget is just where I get my money from, where I'm going to spend it. The thing in Australia, 47% of the government's revenue comes from individual income taxes. That's extraordinarily high by global standards. There's other countries where that's closer to 30. Now that's because they have higher other taxes, like GST is higher, like royalties or tax on natural resources is higher. Norway has almost a flat tax rate of 22%, except on their natural resources, where it's as high as 78%, but it's a complex system, it's a cash flow tax. Norway still has 50% debt, by the way, but they've got a sovereign fund that pays for free education, free childcare and all sorts of stuff. In Australia, we've always been precious about whether we tax the people that pull stuff out of the ground it's sort of, we don't want to do it, but I think people are coming around that we kind of have to do it, because what happens is, particularly with foreign companies, they come in, they'll mine our stuff, and they'll shift through profit shifting, management fees, etc., their profits to overseas. Adani is a good example. They mine coal, all the profits end up in India. They've paid almost no income tax and almost no royalties. Yeah, and you go, I'd rather we did tax, and all mining companies, by the way, by Australia, some sort of royalties. I know for some from the West that's sacrilege, but we're not going to get genuine tax reform. I don't want that money, by the way, to go anywhere near politicians. It needs to go into a sovereign wealth fund, not into the annual budget. Otherwise, it's a recipe for an even bigger disaster. But no one's talking about that. Sorry, Pocock and a few others are starting to talk about it. We'll see what happens. But GST is 13% of the cake. Company and resources tax, 18%. Super fund tax is 4%. Now, and this is why I worry about, will super slowly get chipped at the top end down to pick up some taxes as your vote diminishes and diminishes compared to the under 40s, under 50s. It's got to be under threat. Nothing you can do about it. Enjoy it. And hopefully, the one good thing about super, politically, the Labor Party love it, because where do they want everyone's super to go? Industry super funds. Who's on the board of industry super funds? Labor Party cronies. What do they do with the money they get paid for being on the board? Donated to the Labor Party. So every board of every industry super fund money goes to Labor Party funding. So Labor want super to be popular. So that's a good thing for us. It gives balance out. In terms of where the money's gone, broadly, and this is, I've talked about this in past meetings, this is good and bad. 35% goes to welfare. Now, we know where that affects a family member. We think it's good. When we hear about abuse of NDIS and other things, we think it's bad. And we've got this challenge where governments running anything are disastrous. So we now set up this system where we have agencies that run NDIS, aged care, Indigenous affairs, and it's like snouts at the trough, the profit margins out of those things. I don't know how we fix that. The Labor Party, the budget here is undertaking to fix NDIS, but the savings aren't showing through for another 3 or 4 years. Will they be able to fight back against the states and all these interest groups? And like I said, we all, when we have a loved one that needs aged care or NDIS or whatever, we think it's a good thing. It's just we don't like the big numbers, and it's partly the inefficiency of the system, and ultimately we've got to solve it. I don't know how you solve it. You need hard-nosed business people policing those agencies. Maybe AI will solve it. Maybe we'll be able to work out. Lots of us have donated money to charities. You can look up a charitable website and you can see how much of that money you donate goes through to the end cause. I think some public stuff around the NDIS agencies would be pretty good as well. Now, they've got to do it for profit, but just not excessive. So, for those of you that have structures or assets still outside of super, no rush on this, but as the legislation comes out, you should be sitting down with your people and reviewing your structures. If you've got kids in business or with assets or accumulating, you should be making sure they've got good people to talk through here. The difference between getting this right and wrong will cost them lots of money over their lifetime. The one that's scary for me is the testamentary trust. Every will that has a testamentary trust right now, which is probably lots of you, will need to be reviewed, and the value of those testamentary trusts is pretty much gone. The only reason I would have a testamentary trust, besides having some element of control and protection, is the tax-free money to the grandkids up to $30,000, which otherwise they get taxed at adult rates. So that's a sneaky little... Now, we'll see how that lasts, or whether it's a chicken out thing. I'm going to pause there and see if there's any questions. We've covered a lot of ground.